A mobile phone is an incredibly convenient way of keeping track of your investments, but how do you choose an app which is right for you? In this video, I'll talk about the criteria which I think are important to help you choose one app over another. Now notice that there won't be any affiliate links in this video. That's because I think it's difficult to be objective about choosing the best app if you've got a financial incentive to choose one over another. Now, if you want to keep abreast of global markets, but also the global economy, why not sign up to our free weekly market roundup? There'll be a link in the description below and above me. So let's look at UK investment apps in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. When there are so many apps to choose from, how do you find which is the best app for you? It's easy to get caught up in the tech, which is really not the most important thing. The key thing is how much money you'll make over the long term. Not all of the apps offer exactly the same types of account. And remember that as an investor, you probably want to make sure that you save tax efficiently. If you don't want the taxman to see your capital gains or your investment income, then you'd either have an individual savings account or a self-invested personal pension. And although many of the apps offer an ISA, not so many of them offer a self-invested personal pension. Now, if you don't have your money in either of those tax wrappers, what you'll have is a general investment account. And if that's the case, then you probably will have to fill in a self-assessment tax form. So if you do want to keep your tax simple, then it's probably best to go for an ISA or a SIPP. Another incredibly important thing to consider, which can make the difference between ending up wealthy or ending up poor, is the amount of fees that you pay. Generally, you should aim to keep all of your fees below 0.4% of your invested amount, because if you do, then over a 30-year period, you'll keep about 86% of your investment gains. Whereas if you pay 2% fees, you only get to keep about 40% of your investment gains. Now, where do these numbers come from? If you want to try this out for yourself, then just go to Larry Bates' website in Canada and use his T-Rex score calculator. You enter the amount you want to invest, what your investment return will be, what fees you'll pay, and the period of time. The red line shows your cumulative gain over time, and the orange line is how much of those gains you get to keep. And the difference is how much you pay to the financial industry in the form of fees. So although 2% doesn't sound like much, these fees compound over time. And over this 30-year period, you'll give away more than half of your returns. But if instead you'd paid 0.4% in fees, you can see that the amount you paid the financial industry is much smaller, and you got to now keep almost 90% of your gains. So make sure that you don't get wowed by the technology and read the small print about the fees that you'll pay for each of these apps. When you're looking at the fees that you'll pay, they're split into three types. The platform fee, which is what you pay the company to hold your investments safely and to allow you to buy and sell investments and also report the value of those investments, and generally you should keep that below 0.2%. Then if you buy funds, which are like off-the-shelf portfolios, the fee that you pay for those should again be less than 0.2%. But you also have to consider how much you pay to trade. Now, some of the apps that we'll see don't charge you for trading at all, but you always end up paying in some way, with some combination of these three things. So as an investor, what is it that you can actually buy? Well, you can buy shares, which is part ownership of a company. You can buy bonds, which are loans to companies or to governments. You can buy a slice of commercial real estate, which are sometimes called real estate investment trusts, or you can buy commodities like gold, and with some platforms you can also buy cryptocurrencies. But one alternative, which is very attractive for newbie investors, is called a fund, which is like an off-the-shelf portfolio, and that's already diversified, so it means you're often taking much lower risk than you would with individual shares or individual bonds, for example. Another thing to consider is whether your app encourages bad behavior. Does it encourage you just to chase the funds which have done best recently? Chasing return is often a very bad way to invest. Does it make you overtrade? Perhaps they have a best buy list or what they call research, which turns out just to be marketing to try and get you to trade more. Do they make investment exciting? Although it may seem odd, investment should be as boring as possible. If it's more like gambling, then it's really not investment. And does it encourage something called concentration risk, where you buy stocks in just one sector, such as robotics, or just a single country, such as the US? The best apps are the ones which try to educate you to try and avoid these pitfalls, or even better, through their interface, avoid you being able to do these bad behaviors at all. Now there are two types of app that we're going to consider. The first one is a fully fledged investment platform, and in this video I'll just look at the ones which have an app which you can use on your phone. But a second group, which is kind of interesting and definitely worth a mention, are called saving apps, which allow you to take money out of your bank account, either actively or using some form of artificial intelligence, and then they invest it in some exchange-traded funds or other form of investment. Now I've called them savings apps because they limit the choice of investments. So we'll begin with the investment apps. Now if you're the kind of person that's just starting out an investment, it's often attractive to have somebody else do everything for you, and that's what robo-advisors do. The onboarding process usually involves you filling out a risk questionnaire, which takes around 10 minutes. The robo bit of the fund is what matches your questionnaire answers to a suitable portfolio, which matches your risk appetite. Unfortunately, many of those portfolios are actively managed, which means a group of people try and invest to give you returns which are as large as possible. Unfortunately, active management has a very poor track record, and often you'd be better off with a really simple and much cheaper fixed portfolio. Here are 7 of the robo funds which are available in the UK, and here is their annual fee as a percentage of the amount you invest. Notice that all of these are well above that ratio which I gave you at the beginning, which is 0.4% per year for the platform and for the fund fees. And frankly, I don't find any of these very compelling because of that reason. I guess if I had to choose one, it would be Wealthify because it has the lowest fees. If you are willing to be a bit more active in your investment journey and to spend a bit more time researching your investments, then do-it-yourself apps may be more appropriate, and they're certainly going to be cheaper. This is a table taken from a report by Lang Cat, and it tells you how much it would cost as a percentage in fees if you invest 20k or if you invest 100k, where green is cheap and red is expensive. I've gone through this list and tried to find which of these platforms, which provide ISAs, also provide an app. And unfortunately, many of the cheapest ones, such as Vanguard, don't provide you with an app. But I think I'd pick out 2 favorites here. If you've got around 20k or less to invest, then AJ Bell YouInvest has a very good app and its fees are quite low, at 0.28% per year. And if you have around 100k to invest, then I think Interactive Investor offers the best app, combined with pretty low platform fees. So starting with AJ Bell, they actually charge you differently according to whether you buy shares, and that includes exchange-traded funds, but also bonds. The fee is capped at $7.50 per quarter, whereas if you buy funds, it can be much more expensive, because the fee is 0.25%, and it only goes down if you invest more than $250,000. They also have a trading cost of about £10 per share, but that also includes exchange-traded funds and investment trusts, whereas funds only cost $1.50 to trade. So this combination of a low-cost platform with a wide range of investments, a decent app, which allows you to log in fairly easily if you just want to check the value of your stocks and shares, you do have to enter a password if you trade or put in new money, makes this a very attractive proposition. And this is my favourite all-rounder if you invest around 20k or less. Interactive Investor is probably better if you have around 100k or more to invest. And that's because the fee is fixed at £10 per month or £120 per year for an ISA. You'll pay £240 per year if you have a SIPP. Now remember, that fee is fixed no matter how much you invest. So the more you invest, as a percentage, the amount you pay becomes smaller. So you could always start off with something like AJ Bell, and then as the size of your pot increases, you could switch to another platform like Interactive Investor. But the fact is that the fees on all of these platforms will probably come down over time. Now, some of these do-it-yourself apps say that they're free. One example of that would be Trading 212. But notice at the top of the screen, there's a disclaimer in small print. If we zoom in on that and look at what the text is saying, it's actually talking about contracts for difference. If you're wondering what those are, they're complex instruments that come with a high risk of losing money rapidly due to something called leverage. And here's the nasty bit, which is that 3/4 of retail investors, that's normal investors like you and me, lose money when they trade with this provider. And this disclaimer is saying you should consider whether you can afford to take the high risk of losing your money. In other words, this is a gambling product. So if I was being cynical, I'd say that this is a bait and switch approach where they're trying to lure you in by saying that trades are free, but then they try and switch you onto contracts for difference, which are much more profitable for them. So personally, I always try and avoid sites which allow you to buy contracts for difference, because I think investing gives you a much better chance of coming out with a good outcome than gambling. One platform which I do really like, which does have the word free in the title, is Freetrade. All of the trades you do on Freetrade are commission free, and they are very dedicated to keeping your costs low. If you go for their ISA product, they don't offer a pension yet, it costs you £3 a month. So your annual cost will be £36. And you can see that it compares very favourably with the other platforms. You'll notice one of the menu items here at the top is community, and they actually listen to their community, and they're continually building up the list of funds which are available according to what their community wants them to add. They're also very clear about what they're working on. So they're continually adding more stocks and exchange traded funds. They're trying to make it easier to add money to your account. They're adding more order types, which is something that more sophisticated investors may want. And they say they're working on something called Alpha, which is a premium account that should be launching anytime soon. In fact, I've done a whole video reviewing the Freetrade app. So just follow the link to see that review. Now let's move on to the saving apps. The first one we'll look at is called Moneybox. Now, one of the cool things that you can do with Moneybox is that say you spend £2.40 on a cup of coffee, Moneybox will round that up to £3 and it'll invest that additional 60p into your stocks and shares ISA. So by rounding up these micropayments, you can very quickly start to build up considerable savings. And saving more is a behaviour that should really be encouraged. Now the fees that you pay for Moneybox are fairly high. So there's a monthly subscription fee of £1, but the platform fee is well above 0.2%, which is my definition of reasonable. And depending on the funds you choose, you'll also pay fees for those. For the pension which they offer, you don't pay a monthly subscription fee, and if you invest more than £100,000, the very high platform fee starts to fall for any money above that 100k limit to just 0.15%. There are 3 funds to choose from: Cautious, Balanced, and Adventurous, and they also have an option to switch to socially responsible global shares. It's very transparent. You can see the funds into which they invest for each of those 3 different portfolios, for the Cautious, Balanced, and Adventurous. If you go for their pension product, you have 3 choices: their Fidelity World Index Fund, or the ethical version of that, which is the Old Mutual World ESG Index Fund, or you can go for BlackRock's LifePath funds. And for those funds, you also have to choose a date on which you think you'll want to retire. And the fund gradually de-risks, it reduces the amount of equity as you approach that retirement date. I think my favourite of the saving apps is Plum, and that's because it's quite innovative in that it uses a smart algorithm which looks at your spending patterns and automatically sets aside money without you having to think about it. As always, you should look at the fees that you pay, and although the choice is limited, many of the funds have fees at around 0.2% or even lower. You'll also pay a fee of £1 per month, and you don't pay any trading costs, and you don't pay to withdraw your money. So every few days you'll notice that Plum has been moving money out of your bank account and into your investments. So if you want Plum to be more aggressive, you might put it into beast mode, and that will save more. But if you want to save less, you'd put it into shy mode. So you do have a level of control over what goes into your investments. And the app also has various ways to increase your savings, which remember is a good behaviour. As we saw with Moneybox, you can round up your spending to the nearest pound, and the difference will go into your investments. They also have a weekly challenge where you put progressively larger amounts week by week into your account, or they put aside more money on rainy days, or on the day that you get paid. Another great feature is that because Plum has access to your bills, it can work out whether you could get cheaper bills for the same services, such as your energy bills or your broadband, for example. And it can even help you transfer your account to the cheaper provider. Wombat is geared much more towards people who are new to investing, who want a very simple interface and a restricted set of choices into which they can invest. They offer several beautifully branded, off-the-shelf portfolios into which you can invest, such as AI stocks, gaming stocks, healthcare stocks, and so on. But if you remember, at the beginning of the video, I warned against bad behavior in the form of concentration risk. What I don't like about this is that it encourages you to become too exposed to single sectors. And in fact, two of these funds are globally diversified. That's the Balanced and the Adventurer. But it's really hard to tell that from the interface. They just look like all of the other funds. Another thing I don't like is that they do offer single shares which you can buy, which is generally a very bad idea for people who are just starting out in investing. Most of the time you're best off just buying a whole market, like the whole UK market, or the whole US market, or the entire global equity market with one fund. Stock picking like this is very unlikely to beat that performance. And that's particularly true because all of these are based in the UK. And that's a common bias amongst investors, which is to only invest in stocks you're familiar with, which are your domestic companies. The fact is that the UK is a very small proportion of global equity markets, only about 4% of them in fact. So the neutral thing to do is to only invest 4% in the UK. So I don't like the fact that Wombat encourages domestic bias. What is good about their share offering is that you can buy a fractional share. So if the share price is very expensive and you don't have a huge amount to invest, you can just buy a fraction of a share with a minimum investment amount of £10. Once your account is above £1,000, you'll pay a monthly subscription of £1, and again the platform fee is very high. It's 0.45%, which is much higher than it should be, which is around 0.2%. So amongst the investment platforms, I think for small investors, AJ Bell is probably the best choice because of its low fees, wide range of investment choices, and a reasonable interface. And for larger investors, so you have around 100k to invest, then Interactive Investor is probably the better choice because it has a fixed fee no matter how much you invest. And amongst the saving platforms, my favorite is Plum because I think it's quite innovative and I love the way it encourages you to save. Now, if you enjoyed that video and you want to support us, then why not join our membership? It's just $10 a month. You can see the link above me there, patreon.com/pensioncraft. And if you do join us, then you get access to things like Slack, which is an interactive chat application. So you can talk to me and other members of the community. We also have regular calls where you can ask me questions and I try to answer them as best I can. You can see it's a bit more informal and quite relaxed. I'm not wearing the white shirt. And we have a video library of exclusive content for supporters, which is growing all the time. You can see two of the examples there. And along with the video replay, there are also notes which have links so that you can research things in more detail if that's what you want to do. So if you do want to join us, there'll be a link that you can click on the far right side of this page. And I hope to see you there on one of those Sunday evening calls and on Slack. And as always, thank you for listening.